Bank earnings, JPMorgan, Citi, Wells Fargo post beats, but they see their stocks fall anyway. So banks are posting record profits, and this could be good for consumers because it might mean that the consumers can get better loans, more consumers can get loans, which is good, and also financial stability in the banking sector is essential to an overall healthy and thriving economy. However, despite posting these profits, these banks have either seen essentially no gains in their share price this morning or have seen actual share price drops. So let's talk about why that is, but first let's go over the numbers. JPMorgan Chase tops estimates on better than expected credit costs trading revenue. Here's what the company reported compared with estimates from analysts surveyed by LSEG, formerly known as whatever that is. Earnings $4.44 per share versus $4.11 per share expected. Revenue is up as well, $42.55 billion versus $41.85 billion in expected revenue. The bank said first quarter profit rose 6% to $13.42 billion or $4.44 per share from a year earlier, boosted by its takeover of First Republic during the regional banking crisis last year. Per share earnings would have been 19 cents higher, excluding a $725 million boost from the FDIC's special assessment to cover the costs tied to last year's banking failures. That was a Silicon Valley Bank failure, if you remember that. Absolutely huge news. Revenue climbed 8% to $42.55 billion as the bank generated more interest income thanks to higher interest rates and larger loan balances. So all of that sounds really good, except when you come over to their share price, you can see that in pre-hours trading and basically as soon as the markets opened up, their stock price absolutely tanked. It's down nearly 5% this morning, despite posting much better than expected revenues. And we'll talk about why that is in just a second. But first, let's look at the other banks. Wells Fargo earnings top estimates even as lower interest income cuts into profits. Here's how the company performed, yada, yada, yada. Earnings per share is $1.26 adjusted versus $1.11 expected, and the revenue was $20.86 billion versus $20.20 billion expected. But as you can see, shares of Wells dipped after the earnings report in pre-market trading Friday morning. Wells said its net interest income, a key measurement of what a bank makes in lending, decreased 8% in the quarter due to the impact of higher interest rates on funding costs and a shift by consumers to higher yielding deposit products. Net interest income for 2024 is expected to post a decline in the 7% to 9% range, unchanged from its prior guidance. And as you can see, Wells Fargo also basically remains unchanged. At the time that this article was written and at the time that I wrote this script, you can see that it was actually down, but it has since made a bit of a recovery, but basically is breaking even so far this morning. Third bank we're going to go over, Citigroup. Citigroup tops estimates for the first quarter revenue on better than expected Wall Street results. Earnings are $1.58 per share, but it's unclear if that's comparable to the original estimate because of a big reorganization that Citigroup has gone under the past bit under this Jane Foster, the CEO. But then the revenue was $21.1 billion versus an expected $20.4 billion. But the bank said that profits fell 27% from a year earlier to $3.37 billion or $1.58 a share on higher expenses and credit costs. Revenue slipped 2% to $21.1 billion, mostly driven by the impact of selling an overseas business in the year earlier period. And despite this sounding like the worst one out of the group, as you can see in early market trading, they absolutely exploded in share price, exploded being a relative term, and it's come back down a little bit as I assume people were cashing out quickly on this because the report didn't look as good maybe as the share price had indicated, but it's now essentially leveled out. And also Citigroup CEO Jane Fraser has said that her sweeping corporate overhaul would be complete by March and that the firm would give an update on severance expenses along with first quarter results. Usually layoffs like this cause a stock price to increase significantly, and so probably that's what we saw initially, but then for some reason traders decided that it wasn't actually worth it and they weren't actually maybe either as excited as they were, or maybe they were shorting the stock or what have you, and decided to sell off en masse just a few hours ago, and now we sit at basically no gain for the stock across all three of these major bank players who all posted what should be pretty good first quarter results. Now, the main reason for the dip or the stagnation that we're seeing despite these reports is that even though the banks are posting profits, their core banking activities of lending money and getting back interest and taking deposits have not been doing particularly well. This is back from Marketplace. In the first quarter, JPMorgan's net interest income rose 11% relative to the year-ago period to $23.2 billion. That came in ahead of the $22.7 billion FactSet consensus estimate. First quarter net interest income excluding markets, and this is important, declined from the fourth quarter, however, quote, due to deposit margin compression and lower deposit balances, the company said. Net interest income is the profit the bank makes from loans after paying out interest to customers for its deposits. And this excluding markets probably means that the income is excluding any gains they saw in financial markets or dividends or interest that they got from other companies that they're investing in. And primarily what this is just talking about is the core act of lending money and taking deposits declined by 2%, which is not really what you want to see. That's like a grocery store saying that their profits are up this quarter, and that's great, but their profits are only up because they sold a bunch of Stanley Cups, and in reality, the groceries themselves have actually declined in revenue. You would look at that and think, well, your core business of selling groceries has gone down and you only made a little bit of money because of this thing on the side, so I'm not going to invest in you. And that's essentially what's happening with these big banks. The general fear is that profits are only up because the stock market in general is up. This is the Dow Jones Industrial Average, and you can see since November, it's done quite well, going from about 33,000 to where it is now at just over 38,000. The concern is that if the stock market dips because inflation continues to stay high or the Fed chooses not to cut interest rates, then as it goes down, the profits of these banks will go down with it because their core activities of giving out loans and taking deposits are not making as much money as they have in the past. And the only reason they're doing well, quote unquote, is because the stock market's doing well. If the stock dips and it takes the banks down with it, we might see their shares fall. And so people are concerned about that because it looks like inflation will remain high due to March's CPI report. And so people are pulling out. Now, if you're a shareholder in the banking industry, these banks doing well is actually probably really good for you. Shareholder payouts hit a record $1.7 trillion last year as bank profits surge. And you can see here, the banking sector contributed almost half of the world's total dividend growth, delivering record payouts as high interest rates boosted lenders' margins, the report found. Last year, major banks including JPMorgan Chase, Wells Fargo, and Morgan Stanley, which I believe will be announcing their profits sometime next week, announced plans to raise their quarterly dividends after clearing the Federal Reserve's annual stress test, which dictates how much capital banks can return to shareholders. In addition, lingering post-pandemic catch-up efforts meant payouts were fully restored, most notably at HSBC, Janice Henderson's report added. Now, a lot of this money, as you can probably guess, is going to higher income earners or people who are sitting on the board or people who are in the 1% and have bought a lot of money in the banking sector. But it is important to remember that a lot of middle and lower class people also have stocks in the banking sector, and this huge amount of dividend payouts is really good for them as well. However, someone it is distinctly not good for is smaller banks. What to expect from bank earnings as high interest rates pressure smaller players. The evolving picture on interest rates, dubbed, quote, higher for longer, unquote, as expectations for rate cuts this year shift from a once anticipated 6 reductions to perhaps 3, will boost revenue for big banks while squeezing many smaller ones. See, small banks can't keep up with the financial incentives of the big banks, and that risks them losing customers as people leave the small banks that can't keep up with like high yield savings accounts rates and so on and so forth to go to the big banks that will be willing to give them that kind of money. This is a problem because if the smaller banks start to fail, the big banks will buy them up, and that will start to cause banking consolidation. And we don't want banking consolidation because if the banking sector consolidates and then that one big bank fails, then everyone is screwed. But overall, unless you're a shareholder in either a large bank or a small bank, by and large, this news and these reports should not mean anything to you right now. Before you make any big decisions on anything you want to do or choices you want to make around this, wait until we see more information about future inflation rates or whether the Fed is going to cut interest rates and whether real estate continues to go up at the rate it is or if it starts to come down. Thanks for watching.